Today, we're diving deep into Warren Buffett's 1997 letter to shareholders. Now, why this one? Because it's an absolute masterclass, written right on the edge of the dot-com bubble. What we're going to do is pull out the practical playbook from his thinking, because these principles, they're just as critical for any professional investor today as they were back then. They are absolutely timeless. Right out of the gate, Buffett hits us with this incredible analogy. He's writing this as the market is going crazy, and with one sentence, he just completely dismantles the whole idea of being a genius in a bull market. It's a foundational warning, you know? A rising tide lifts all boats, or in this case, all ducks. And that duck analogy, it leads us straight to the central question for any of us. When the market is just soaring and everyone feels like a winner, how do you tell the difference between pure skill and just dumb luck? How do you really measure outperformance versus just riding the wave? This question, right here, is the bedrock of Buffett's entire philosophy. So to answer that, we've got to look beyond just the raw numbers, beyond the simple change in net worth. Buffett says a right-thinking duck isn't just looking at how high it's floating. No, it's benchmarking. It's comparing its performance to all the other ducks on the pond. And for Berkshire, that benchmark was, and still is, the S&P 500. Okay, to really get what makes Berkshire tick, Buffett insists on breaking it down into its two separate engines. On the left, yeah, you've got the investment portfolio. But look at the right, and this is crucial. Those are the pre-tax earnings from the actual operating businesses, with all the investment income totally stripped out. Looking at these two value drivers separately gives you a much, much clearer picture. You know, the pundits back in '97 who just saw Berkshire as a big stock portfolio, they were missing half the story. They were missing the colossal growing value of its actual businesses. This is such a powerful analytical framework for looking at any complex company. This kind of disciplined analysis, it builds into a whole philosophy of action. Or actually, maybe it's better to call it a philosophy of inaction. In a hot market, when the pressure to put capital to work is just immense, Buffett's approach is, well, it's radically different. He frames his entire capital allocation strategy around this simple analogy from baseball legend Ted Williams. Williams famously divided his strike zone into 77 little cells, and he knew he would only swing at pitches that were right in his absolute sweet spot. For Buffett, those pitches are investment opportunities. And back in '97, he saw most of them as being way outside the strike zone. And see, this is how that sports story becomes a real, repeatable process for investing. It's all about discipline. First, define what you're looking for. Then, recognize it when you see it. Have the patience to ignore everything else. And then, when that fat pitch finally comes over the plate, have the courage to swing for the fences. Now, we can't really talk about Berkshire's playbook without getting into its economic engine. I'm talking about the massive and honestly often misunderstood power of insurance float. This is the fuel that lets him take those big swings when the fat pitch arrives. Okay, let's be crystal clear on what float is. It's basically the cash an insurer gets to hold because you and I pay our premiums up front, but the claims get paid out way later. Now, technically, it's a liability on the balance sheet, but Buffett realized that if you manage it right, it could be an incredibly powerful, permanent source of capital. This table, wow, it tells an amazing story. That cost of funds column is basically the underwriting profit or loss. Just look at 1997. Berkshire was holding over $7 billion in float, and the cost was negative. That means instead of paying interest on that money, they were actually getting paid to hold it, all while earning returns by investing it. It's incredible. The result over 3 decades is just staggering. In total, this massive, growing pool of investable cash came at less than zero cost. Buffett effectively turned a liability into an asset that's even more valuable than an equal amount of equity. It's just brilliant. But, and this is a big but, this doesn't come without risk. Buffett is very, very clear about the dangers, especially in the super catastrophe insurance business. He knew that a massive loss wasn't just possible, it was inevitable. The whole game was about pricing that risk correctly and having a strong enough balance sheet to take the hit when it finally came. So, with all this capital coming in from float and the operating businesses, how does Buffett think about using it for big acquisitions? Well, this brings us to a challenge that's kind of unique to really successful companies. He calls it the .380 hitter problem. Buffett draws this really hard line between buying companies with cash versus using his own stock. See, using cash just adds a new asset to the portfolio. Simple enough. But using Berkshire stock, Well, that means you're trading away a small piece of every single one of your existing incredible businesses, from Coca-Cola to See's Candies. And this is the analogy that just crystallizes the whole idea, right? Buying a .350 hitter is great, but not if you have to trade your .380 hitter to get him. When you use your own high-performing stock, you're diluting the quality of what you already have. For a company like Berkshire, trading up was almost impossible. All right, let's shift gears from corporate strategy to the investor's mind. Because for Buffett, having the right frameworks is totally useless if you don't have the right temperament. And a huge part of that is learning to think about market swings in a completely counterintuitive way. So Buffett poses this super simple question. If you know you're going to be a net buyer of stocks for the next few years, just like you're going to be a lifelong buyer of hamburgers, you should, logically, want lower prices. And yet, what do most investors do? They get giddy when prices rise and totally depressed when they fall. So he offers this powerful little mental trick to fix that flawed impulse. The next time you see a headline that says, "Investors lose as market falls," just re-edit it in your head. It's not investors who are losing, it's the sellers, the disinvestors. The long-term buyers, we're gaining because our dollars now buy more. And the benefits here are very real, they're concrete. A falling market means your capital just goes further. The great companies you already own can buy back their own stock at a discount, which increases your personal stake in the business without you spending a dime. Market declines are an opportunity, not a disaster, for anyone who's a net saver. And this brings us right back to where we started. In that high-flying market of 1997, Buffett ends with this warning from his mentor, Ben Graham. High prices, which are always born from a cheery consensus, they shrink your margin for error, your margin of safety. And that's exactly when discipline and the right mindset matter most. So this leaves a final question for you to really think about. In today's market, right now, are you thinking like an investor who stands to gain from lower prices? Or are you thinking like a disinvestor who's afraid of them? Your answer to that question might be the single most important takeaway from this entire playbook.